All right. Well, good afternoon, everyone, on this stormy Thursday in West Lynn, at least. So if just a heads up to all of you, as I'm sure we have more folks trickling in, if the power does go out at the Northwest Gas Association offices, that will be we'll end up having to cancel the webinar, although so far things look good. But just a heads up, if everything goes dead, you may have lost us here in West Lynn. So with that said, I'm Ben Hemson. I'm the communications manager here with the Northwest Gas Association, and I'm joined by Grant Forsyth, the chief economist for Avista. And Grant is always a popular speaker at our annual energy conference, and today he'll be giving the 2016 economic outlook, letting us know what to expect as we head into the holiday season and beyond. So before I turn it over to Grant, I just want to run through a few logistics here. For those of you that are not familiar with the Northwest Gas Association, I saw a few unfamiliar names on the registration list. Here's who we are. Here's a map of our members. We represent the 6 investor-owned natural gas utilities operating in our region, along with the 3 large natural gas transmission lines. Our members are located in Oregon, Washington, Idaho, and British Columbia. As always, if you want to know more, you can go to our website, nwga.org, and find out more info there. So a couple of things to plug first. Next webinar, we're hosting one on Thursday, January 28th. We'll be discussing discourse on social media with Zach Hyder and Becca Sturbens from Quinn Thomas. Quinn Thomas does a lot of work with energy companies in the region, so although that will be a communications-focused webinar, there will be, I think, some energy relevance there for any of you that engage on social media, have employees that engage on social media, or just generally interested in what's going on in that forum. You'll have a different moderator for that one because I am actually leaving the association for a new position in Bend at the end of this month after 4.5 great years here. So I've slipped a little money to Grant, and he will be he'll be bumping up the economic outlook for east of the Cascades in Oregon for me. That's not actually true. But also, as I mentioned, Grant's always a very popular speaker at our annual energy conference. He's on the agenda again for this year, I believe. So mark your calendars now, and you should see some more information on that coming in January or early February. One last logistical thing here. If you want to ask questions, as always, 2 ways you can do that. You can use the little chat box on the GoToMeeting control panel. Please either address the entire audience or the organizer and shoot your question to me that way. I'll act as the moderator and I'll jump in. If you're looking for clarification, I'll interrupt Grant at a good moment to get clarification. If you're looking for more general questions, I may hold those to the end, and I'll try to give you a heads up which way I'm leaning when you submit your question. If you're a little too shy or not comfortable with the chat box, you can also respond to my email that I sent you this morning to access this webinar. I'll be monitoring that during the presentation, and I'll jump in again with questions for Grant as the opportunity arises. So with that, Grant, I'm unmuting you here. You should be able to talk now, and I will make you the presenter, and away we will go.
All right.
You're coming through just fine, Grant.
Okay, great. Well, welcome everybody. I would say only the dedicated would take their lunch hour to listen to an economist, and if you're not dedicated, you're probably lonely. But either way, I appreciate you being here today. What we're going to do is we're going to kind of review the macroeconomic situation in the U.S. and Canada, and then we're going to move on to the regional outlook. Now, for those of you who were at the Northwest Gas Association conference in June in Skamania County, this is really kind of an update of that outlook. And so we're going to talk a little bit about how things have changed since I spoke in June. So let's first look at the macro environment here. What this is an analysis of consensus forecasts. So let's focus on the U.S. first, and then we'll move to Canada. Looking at the U.S., what I do is I track a large number of forecast surveys, and then I average across those surveys for the U.S. So it's an average of an average. And so we see forecasts for 2015 and 2016. We see forecasts that were done in June 2015, and then we see the new forecast for November 2015. And what you can see for the U.S. is the consensus view is that, you know, there's not going to be a big change between June and November forecasts, and 2016 is supposed to be an okay year, but not a great year for the U.S. I mean, just keep in mind, prior to the Great Recession, it was normal to have long-term growth at about 3%. Increasingly, if we see anything over 2.5% in the U.S., that's going to be considered a really good year. If we focus on Canada for a minute, and this is a survey done by the Department of Finance in Canada, which is roughly the equivalent of the U.S. Treasury, we can see that 2015 is going to come in much weaker than what was forecast in the March survey. In fact, I mean, depending on how you define recessions, you could argue that Canada went into a mild recession with 2 quarters of negative GDP growth in 2015. So from 2% probably to about just over 1% this year in terms of GDP growth. And for 2016, we're looking at 2% versus 2.2% from the October, from the March survey. Now, the important thing to remember is that North America has not failed to disappoint relative to forecast. And so we do have some headwinds. I would actually not be surprised to see both the U.S. and Canada come under what the consensus forecast is for 2016. Especially in the case of Canada, we're seeing oil prices fall. This morning I looked on the Chicago Mercantile Exchange, and they had fallen to price per barrel for Brent was under $40. So some headwinds there, but what we're going to see again is okay growth, but not great growth. Focusing a little bit more on the U.S., this was a graph I presented in June, and it's looking at what is the Federal Open Market Committee's long-run forecast for GDP growth. And really what this is what does the Fed expect U.S. GDP growth to be under normal economic conditions with no economic shocks and normal monetary policy. And so what they do each time they have a meeting of the FOMC, they poll the members who are participating in the meeting and get their forecasts for U.S. GDP growth in the long run. What they do then is they remove the highest 3 forecasts and remove the lowest 3 forecasts to get what they call the high of the central tendency and the low of the central tendency. And that's the blue and red line. The black line is just the average, that black dotted line is just the average of the 2 central tendencies. Okay. That dashed box that you see, that's the new data that I did not have when I showed this slide in June. And what it shows is the Fed has actually gotten more pessimistic about U.S. long-run growth. It's now viewed to be about 2%. Now, keep in mind, in 2011, they were thinking it might be around 2.6%, and now long-run growth, that expectation is now closer to 2%. That's a big change, and so clearly the Fed is more pessimistic about long-term growth. This is important for the U.S. because it has a lot of implications about our ability to balance our budget in terms of being able to balance it through growth. And so definitely a more pessimistic look out for the U.S. Now, if we turn to inflation, you know, no great surprise here. That yellow line that you see there is the target for the U.S. and Canadian central banks, 2%. That's the central target for consumer inflation. The red is Canada, the black is the U.S. You can see because of energy prices, we're well below that 2% target. We're actually, in the case of the U.S., maybe a little bit in that deflation range. And again, that dotted box shows what I didn't know when I gave this presentation in June, and you can see that prices have remained relatively muted. What's interesting is that if you remove food and energy, and those are the dashed lines that you see, we're still below the target range of 2%. Now, if you look at forecasts for inflation from 2016 going forward, everything is still anchored about 2%, which means most people do expect these central banks, both in Canada and the U.S., to be able to maintain long-run inflation around their targets of 2%. Now, focusing on the output side a little bit more, and this is industrial production, and this is looking at the output of mines, manufacturers, and utilities. And you can see that there's definitely some weakness on the industrial side, which does have implications for the gas industry. And so when I gave this presentation in June, there was definitely some weakness coming into industrial production, and that weakness has continued, with Canada actually showing some negative growth up through the third quarter. My expectation is that industrial production is going to remain weak, in part because we have weak growth outside of North America, and because of the next slide, which really shows us exchange rates. So what we can see here is this is the Canadian per US dollar and the trade weighted per US dollar exchange rate. I have indexed everything to 2012. And what's interesting is how much the Canadian dollar has appreciated, and going into the summer and fall, it appreciated even more. So at the time I originally gave this presentation in June, the Canadian dollar, or I should say the US dollar, has appreciated about 25%, and it has continued to appreciate, and now compared to 2012, the US dollar has appreciated about 30% against the Canadian dollar. Okay. Of course, this makes it a little bit difficult for US producers in terms of being competitive. Now, if we shift to more of a regional look, really the US Pacific Northwest in terms of employment growth looks really pretty strong. However, going into the second and third quarter, we saw just a little bit of softening in terms of employment growth, but still well above US growth. And if you were to divide out each one of these states, Washington, Idaho, and Oregon are actually all growing about the same rate, around 3%, or about 1 percentage point above the US rate. So we continue to be fairly strong compared to the US, but there has been just a bit of softening in growth. But the good news is though growth in the Pacific Northwest and the US is broad-based, it includes both goods and services, which is a healthy sign. Now, one of the things I like to track is the Federal Reserve Bank of Philadelphia has leading indicators for all the states in the US. And if you look at the indicators for Washington, Idaho, and Oregon, they are predicting some softening going forward. And that's what this next slide shows. So what these are is this is the time series of the leading indicator for the US, the Oregon state, Washington, and Idaho, again coming from the Federal Reserve Bank. And what it's really measuring is how is the economy going to grow in 6 months? What is the economic growth rate going to be in 6 months as measured by this leading indicator? And you can see that following the spring, okay, there was a softening in these leading indicators, indicating that we should expect to see in the US Pacific Northwest economic growth slow as we get into the new year. And that's not too surprising to me. I mean, we're growing so much faster than the US. It's hard for me to imagine that would be sustainable forever. Okay, so again, the leading indicators suggest that we're going to have some softening, at least on the US side. Now, many of you know, who have seen my presentations, I always like to have one graph that's virtually impossible to understand except by me. I guess I always like to feel smart once in a while, and that's this graph. And what it is a scatter plot of the smaller MSAs in the Pacific Northwest on the US side. Now, one of the features of this recovery we've had is that the recovery really started in the large MSAs first and has been slow to come into the smaller MSAs. And so what I'm showing you here is a scatter plot. The red dots represent Washington, the blue dots are Idaho, and the green dots are Oregon. And these are the smaller MSAs in the region. And so on the horizontal axis, you see first quarter year-over-year growth in employment. So that would be the first quarter of this year, graphed against the third quarter of this year. The black line is a 45-degree line. And so the way you should interpret these dots, if a dot is lying above the 45-degree line, it means that MSA is growing faster in the third quarter on a year-over-year basis than in the first quarter. If the dot is below the line, it means third quarter growth is lower than first quarter. So there's been some slowing in employment growth in these smaller MSAs. If you look, you see a big black box square there. That's actually the U.S., so you have a sense of how we're growing relative to the U.S. And so I can go ahead and put names on these cities. And what we're seeing is, except for Yakima, Washington, Idaho Falls, Idaho, and Medford, Oregon, most of the smaller MSAs, although they're still growing at a pretty robust rate, they have slowed a little bit between the first and third quarter. And again, I'm not too surprised by that. The growth rates that we saw in the first quarter were incredibly high, probably not sustainable in the long run if you look at the overall economic environment regionally and in the U.S. But again, not bad, and it's overdue for a lot of these MSAs because, again, the recovery came pretty late to these folks. Now, turning to BC, the good news is that since I gave this presentation in June, growth in BC has definitely picked up. There's been some real weakness relative to Canada, although both have declined. BC went through a real weak spot as there were some adjustments to the housing market, and they were experiencing slower growth because of slow growth in their main export markets. But what we're seeing now is that growth has started to pick up in BC. That's very good news. And if you look at the data that's now available for October and November, okay, going into the fourth quarter, growth has accelerated even a bit more in BC, and it's relatively broad-based geographically, meaning if you look at the different metropolitan areas in BC, it seems to be widespread employment growth. This is good news. The outlook for BC, if you look at the forecast from the large banks in Canada, is for BC to continue to grow in 2016 in terms of employment in the low 1% range, which is certainly better than how it's performed in the last few quarters. Now, talking about the housing market, again, also looks pretty healthy on the U.S. side. This is cumulative single-family units permitted. So I'm looking at single-family homes. Cumulatively, what has been the accumulation of single-family permits relative to third quarter 2015 versus third quarter 2014. And again, this is indicative of a housing market that's still recovering in the U.S. If you look at home prices are also recovering at a decent rate across the U.S. Pacific Northwest. Canada, interesting thing here, a little bit of a housing adjustment going there. Permitting is actually down for Canada overall through August, but if you look through January through August for BC, they're actually up 7%. Now, it's interesting, I read an article yesterday from CBC, which is the Canadian Broadcasting Service, and it's apparently in Vancouver, one of the things that's happened is home prices are beginning to accelerate quite rapidly again, and they're warning everybody that property assessments are going to be quite high in BC this year when they're released. And so one way to think about it is that Santa's got a surprise for those people living in Vancouver, BC. It is, in fact, an area that the Canadian Central Bank is actually concerned about, is that the home prices in a lot of the main urban areas are rising so rapidly. Now, taking a little bit different track, I want to look at a long-run issue, and that's population growth. And the question is the West the best? And the answer is, yeah, it turns out it is. If you look across the U.S., population growth in the U.S. is now around 0.7 or 0.8%. And so anything at 1% or higher is, in fact, what I would call raging population growth. If you compare the South and West to the Northeast and Midwest, we definitely are in a better situation in the West in terms of household formation. Same with Canada, pretty robust growth in Western and Central Canada, although Central Canada growth is likely to slow a bit because of the employment growth slowing there due less jobs in the energy sector. Okay. But overall, the West is growing quite rapidly, and it's important to point out that one of the important drivers of this in Washington, Oregon, and BC is in-migration. That is, in particular, people coming from other countries and moving here. Unfortunately, the U.S. is still struggling with this issue. The Syrian crisis has made it even more political in the U.S. But in the end, a lot of the population growth in the West is due to this external in-migration. If we just focus on the states and BC, you can see again we're all in that 1% range, which again is relatively high given the long-run demographic trends that we're facing in both countries. Now I want to spend some time talking about this last issue. This is the Federal Reserve Bank of Philadelphia Partisan Conflict Index. And this is a relatively new thing that's being published by the Federal Reserve Bank of Philadelphia. And it's really quite interesting. What they do is they have a search engine that goes out and searches all the main newspapers in the US for articles related to partisan conflict at the federal level. And the index is actually its base year is 1990, and it looks at how severe is partisan conflict based on a search of news articles in major newspapers. And you can see here, what's really kind of interesting is that partisan conflict during the Great Recession actually declined. And it makes sense because, the politicians were pulling together to try to save the country and, quite frankly, save themselves. But after the recession ended, what we see is a large increase in partisan conflict. And in fact, the Federal Reserve has actually calculated this index on an annual basis back to the 1890s. And it turns out the last time the US had this much partisan conflict was in fact in the 1890s. And so what we did is we moved from the Great Recession to what I like to call the Great Snit. Okay? Now the problem with this is that all of this partisan conflict, although sometimes it's necessary to solve problems, what the Federal Reserve points out is that if it keeps going on and on and on, it tends to degrade the long-run economic growth because it creates so much policy uncertainty among economic actors, that is households and businesses. And so going forward, one of the drags potentially on US growth is this continuing Great Snit that's occurring at the federal level, where we see ongoing conflict with no resolution. Now the good news is Canada has a slightly different political system, it's got a parliamentary system, and you tend not to see this kind of conflict. So it is in fact probably a much bigger risk for the US. Now, in terms of Canada going forward, probably the risk to Canada is, again, not this partisan conflict. The risks going forward are probably things like oil prices, okay, which we've already talked about, the fact that you have a lot of areas where you still appear to have an asset bubble in the housing market, but also one of the issues confronting Canada is an extremely high, historically high amount of debt carried by households. And so these are other things that specific to Canada that we need to be aware of that could potentially affect economic growth. And so with that, I want to make sure that we have plenty of time for questions. So that's really my last slide.
All right, thanks, Grant. Well, folks on the phone, please submit your questions. If anything came to mind during Grant's presentation, I know I'm going to take the Great Snit and use that phrase all over the place from here on out, Grant. That's fantastic. So any questions? If you're furiously typing right now, we'll certainly make time for you all to finish typing. But Grant is has a wealth of information on the economy in the Northwest, so don't miss out on this chance to pose some great questions to him. Man, not a whole lot of questions.
Nothing.
Nothing. Nothing. All right. Huh. Well, I guess if no one has any questions, we can wrap this up early. Oh, here we go.
Oh, yeah.
There's one. So one for you, Grant. Why are we not seeing natural gas prices drop at the consumer level? Is that one you want to?
Yeah. So when it comes to one of the things, there's a little bit of a lag between the time the wholesale prices of gas fall and when that gets passed on to customers. There's a process called, it's what we call it in the U.S. as a purchase gas adjustment. And so gas prices come down. It takes a little while for us to go through a regulatory process to recognize those lower gas prices and then pass them on to customers through a rate adjustment. And so there is, in fact, a bit of a lag that's occurring there because of this regulatory process of passing lower gas costs on to customers.
Thanks, Grant. Here's another one we just got. What are the primary economic growth drivers in areas outside of the large metro areas in Washington and Oregon?
So it's actually, again, if you look at those areas, it's actually fairly broad-based again. So you're seeing growth in both the manufacturing, or what I call the goods-producing sector, which is manufacturing and construction. And you're also seeing it in the service sector. Private services are also growing. But also, very importantly, is that you're no longer seeing large contractions of government employment. One of the things holding back some of these MSAs was that local government went through a pretty strong contraction through the Great Recession. And so that was pulling down growth because in some of these communities, government employment is a relatively large share of employment. Now what we're seeing is that that's no longer the case. Government at the local and state level is either stabilized or is growing again. So you've got goods producing, growing, you've got private services producing, growing, and then you've got government at least not acting as a contractionary influence.
All right, and any other questions for, oh, here we go, another one. Oh, okay, a good one here. As a past resident of Bend, Oregon, I saw a major run-up in real estate in 2005 through 07. The fall was tragic. Are we heading for the same?
You know, I don't think so. I mean, when I look at the trends, at least in our service area, the growth rates that we've been seeing have really just taken us back up to the price levels we would have seen under the pre-bubble trend. And so, in other words, if you ignore the bubble part of home prices and you just trend out using the trend that was in place prior to the bubble occurring, we've more or less returned back to that pre-bubble trend. So it's as if the bubble had never occurred. And so right now, the growth that we're seeing is really taking us back up to that pre-bubble trend. And so far, I'm not terribly concerned with what I'm seeing on that front. Probably if there's a bubble again, it's going to be in the major metro areas like the Puget Sound, the Portland area, San Francisco, and certainly the message we're getting out of Vancouver is that's also the case there in Vancouver, BC.
Great. Thanks, Grant. Now we've got a few here, so keep sending your questions in, folks. How significant do you think the Fed raising interest rates while Europe is still loosening will be on the economy?
Well, it's certainly going to put upward pressure on the dollar. I mean, for sure, because it's going to widen that interest rate differential between the U.S. and these other countries. To some extent, the expectation of that occurring has already impacted exchange rates. And so I think that it'll mean that the dollar is going to be strong for a relatively long period of time. Specific to Canada, if you look at the futures markets for Canadian dollars versus the U.S. dollar, it is interesting that the markets, at least as of today, don't expect a big change in the current exchange rate going into the spring. But it does mean the dollar is probably going to continue to be strong relative to these other major trading partner currencies.
All right. So book your European vacations now, then, right?
Well, you know, I'll be honest. My wife and I just took a trip. We really like Ainsworth Hot Springs up in BC, and you know, it was, to be honest, a pretty great deal, at least for the Americans that were there.
Mm-hmm. All right, I've got a bunch of questions here now, Grant. They're really flowing in. So here's a good one. Can you talk about the demographics of immigration? You talked about immigration already a little bit, but how much of it is external to the U.S. versus, say, post-college grads in that 25 to 34 demographic? And are there any other considerations as well?
Yeah, I mean, so, you know, in terms of internal migration, so if you're talking about migrating internally, you know, from one place in Canada to another or one place in the U.S. to another, it really, one of the big drivers is going to be how good is your regional economy? You know, how good is job growth? Because increasingly, you know, people's willingness to move someplace is going to be connected to the economic opportunity they have when they get there. And so I think increasingly, you know, the stronger your local economy is, the more in-migration you're going to see. Now, specific to the Pacific Northwest, I think a lot of the international migration that we're seeing are people in that prime working age. And there's a lot of benefits to seeing a certain amount of that immigration coming in. A lot of the immigration that we're seeing is certainly in the larger urban areas is relatively highly educated immigration. They're bringing a lot of skills. And I'm a little bit concerned that in response to the Syrian crisis and some of these other refugee crises, it's just going to be another excuse to clamp down on immigration in the U.S. And I think potentially that could be a problem for the economy in the long run in the U.S. because these people are bringing a lot of skills, they're bringing household formation, they're in that prime part of their life, and there's benefits associated with that.
Great.
And definitely that international migration is definitely going to be important for, again, Vancouver, BC, Puget Sound area, and the Portland area.
Mm-hmm. All right, thanks, Grant. So I'm going to combine a couple of questions here because they're quite similar. So first, generally, any thoughts on the economic impacts of Governor Inslee's approach to carbon for Washington State? And then a follow-on to that, should any of the Washington carbon initiatives be implemented, what do you see as the economic impact, and do you see any economic leakage then to surrounding states?
Oh, wow, that's a big one. Okay, so I actually, I serve on the Governor's Council of Economic Advisors for Washington. We had a meeting with Governor Inslee in September. This issue actually came up. My sense from speaking to the governor in this meeting is that he's still very much committed to the cap and trade system rather than a tax on carbon. Okay, so he's definitely going in that direction, or still wants to go in the direction of cap and trade. In this issue, increasingly, at least in Washington State, is tied up with the current budget problems in Washington associated with what's called the McCleary decision. I'll try not to bore everybody with this, but essentially the state Supreme Court ruled in Washington that we're underfunding K through 12. And as a result, the state needs to come up with significantly more dollars in order to finance that. And to the tune of maybe $3 billion a year from the state. And one of the issues is whether or not some of the revenues collected either from a cap and trade or a carbon tax could go towards that. I think the governor's position is that the best way to fund K through 12 might be through a cap and trade system rather than a carbon tax. The problem in terms of determining which is the right one of the problems I'm having is it's sort of it's the devil's in the details. What are the actual details of the two different options? And some of that is really kind of unclear at the moment. So it's hard to make, from my point of view personally, make a good decision about which is the right way to go.
Okay, a couple more questions here, Grant. What do you see the impact of the, I don't even know if I'm saying this right, the yuan becoming a reserve-based currency?
Well, that's probably was going to happen anyway. I mean, I don't have any great concerns about it. The only thing is this issue of convertibility. I mean, I think if it's going to be a major reserve currency, I think the Chinese have to move pretty quickly to full convertibility. And to me, I mean, that just makes a lot more sense if you're going to have it as a major reserve currency.
All right, let's keep shifting gears here. So relative to household formation, we hear about the delayed adulthood of the millennials, myself included in that one. How do you see this impacting household formation?
I think it could, I mean, if it's true that young people are going to be living with their parents for a longer period of time, I mean, it's going to slow household formation. I mean, I don't see how it could not. Now, the question is whether or not that's really a long-run trend, and that's still, I think, open to debate. I think the issue that's probably just as important right now is to what extent will people choose apartment living for a longer period of time versus owning their own home. What we're seeing certainly in the U.S., in the Pacific Northwest, is we're seeing quite the boom in apartment building. So clearly the real estate development community tends to believe that people are going to be in a rental situation longer than for a longer period of time than they have in the past in terms of when they're ready to actually buy a home. So that's another issue people need to think about in terms of when a household is formed. Is it going to be formed for a longer period of time in a rental situation versus an ownership situation? And again, it's starting to look like at least the real estate side believes that rental situation is going to last longer than it has in the past.
All right. Well, we have a question here, Grant. I'm sure it's a good one from Mike. Can you see it there in the chat box? It's got a lot of acronyms that you may recognize that I don't.
I don't see the chat. Let me see if I can see the chat box here.
Should be in your little GoToMeeting window there. I guess the gist of it is
Building spike in housing.
There's a couple of questions in there to unwind, actually, but
yeah.
I'd say the gist of it is the reality matching up with the projections around housing starts and expectations? Does that sound about right?
Well, what I would say is when I talk to people, at least builders here in the region that we serve, they still see permitting as being unusually low based compared to historical standards on the single family side. And so, I mean, my guess is they may be concerned that we're underbuilding on the single family side. Again, the jury's still out there. Whereas, one of my concerns is maybe we're overbuilding on the apartment side. But again, it's going to take a couple more years for these things to sort out to find out whether or not we've overbuilt the apartments and underbuilt the single family. Again, going back to that issue of housing bubbles and this kind of thing, except for select urban areas, I don't really see that right now either. I'm not sure that's quite getting to that question, which is fairly complicated.
All right. Well, thanks, Grant. We'll give a quick opportunity here if anyone wants to get one last question in. Otherwise, we'll wrap it up. Grant, I appreciate you taking the time, and hopefully,
No pleasure. It's all my pleasure.
Yeah.
And if anybody has any questions, they should feel free to contact me via email.
Great.
And if anybody wants the presentation, I'm happy to send it to them.
Yep. And Grant, I think you said it's okay for me to share that as a PDF afterwards, right? So.
Absolutely, you bet.
So for folks on the phone, I'll have a recording of this, and I'll share the PDF by email and share Grant's email address. I'll have that all out to you this afternoon, so keep an eye out for that. With that email, we'll have a very short survey, like 2-minute survey. Just let us know what you thought, any ideas for future topics. That's all going to be really valuable as we look to plan out the next year of webinars. So please take the time to fill that out. And finally, mark your calendars, January 28th with Zach Hyder and Becca Sturbins of Quinn Thomas, and you'll have a different moderator, as I mentioned, someone with far more gravitas than I have, my boss, Dan Kirshner. So thanks all, and thanks again, Grant, and talk to you all soon.
Thank you very much.